Volatility skew and smile. Implied volatility is not constant. And let me just stop right there. Why do we need to know about implied volatility? Because option values are dependent upon volatility. Specifically, the greater the volatility, the more valuable the option will be. But what we're saying here is that the volatility that's priced into options on the same underlying asset is not consistently applied. And as a result, we get two phenomenon. One of them is referred to as a volatility smile, and the other one is referred to as a volatility skew. Now we're going to explain each one in greater detail, but first I want to show you the images so that you know where these terms came in from. So you can see with the red line here, kind of looks like a smile, right? And the blue line there indicates the volatility skew. And the way we got these is by plotting the implied volatility at various points for the strike price. So perhaps we should look at the horizontal axes now. And over here we have the current spot price of the underlying asset. So in this segment, you have a scenario where the spot price would be greater than the strike. So for example, if you had an option with a strike price here, then you could clearly see that the spot price is greater than that strike price. So that's exactly what we're saying there. But if that's the scenario, ladies and gentlemen, if the spot price is greater than the strike, what can you tell me about the calls? They would be in the money. Because then, you'd gladly pay X in order to receive an asset that's worth the spot. On the other hand, in this specific scenario, the put would be out of the money. Because again, you could see that nobody would deliver this asset and get a lower strike price for it. Now let's look at this segment of the horizontal axes. So again, the trick is just to pick a point there, and this would be your strike. So if that's the case, then clearly the spot price would be less than strike. So that's exactly what we got there. Now, if that's the case, so now that we've demonstrated that this segment here, you have a spot that's less than the strike price, the call itself would be out of the money. And once again, a call gives you the right to pay strike in order to buy an asset. Well, I'm not going to pay a higher strike in order to buy a lower valued asset, so it'd be out of the money. On the other hand, if you're looking at a put within this range, then it would be in the money. For example, I would gladly deliver this asset, which is worth the spot or the lower spot, and receive the higher strike price for it. So it would be in the money. And of course, in the situation where the strike is right there, where it's equal to the spot, then both options would be at the money. So the very first thing we needed to do in order to explain volatility, smile, and skew is to read this framework properly. All right, so now we can continue. So the first thing we're going to try to explain is a volatility smile. And here's the way we go about it. When the spot price is equal to the strike, in other words, when the option is at the money, let's see where that is. That would be right here. So if the strike was there, now do you see how it just pops out right away? What is so unique about this point? It's the lowest implied volatility. So the market expects the lowest possible volatility at that point in time, because the markets are thinking, oh, the spot is hovering close to strike, and therefore maybe they don't expect the price to make a large movement. However, once the spot price deviates from strike, in other words, if you're in this range, so if the spot is now deviating from strike, in which it's either more or less than the strike, what happens to implied volatility? So if this is the lowest point, you go anywhere else, and guess what? Now you have a higher implied volatility. So the volatility goes up, and same thing on the other side. So if that's our minimum point, if you're in this range, again, you could see that the implied volatility will be higher. And that's how you get the resulting volatility smile. Now, what's the rationale? What's the explanation behind this? Well, as soon as the spot price deviates from strike, again, whether you're here or there, all of a sudden, the market starts anticipating a higher volatility in the future. So the rationale is, if the spot and strike are close together, the markets have a low expectation with regards to volatility. But as soon as the price deviates from strike, all of a sudden the markets start raising the amount of implied volatility priced into the options. So now what we're going to do is we're going to try to explain volatility skew. And here's the rationale behind volatility skew. The markets do not view volatility in a symmetric fashion. For example, look at this framework right there. So this is return, and of course this oscillation is volatility. So if you look at economic models, they just consider this as volatility, but they don't pay attention to the upside and downside volatility. So this would be the upside volatility, and this would be the downside volatility. However, human nature thinks otherwise. So as per behavioral finance, a negative volatility has a greater impact on utility or emotional reaction than a positive volatility. And this is true, ladies and gentlemen. For example, a plus 10% return and a minus 10% return generates different emotions. Now, if I ask you which generates a stronger feeling, this does. And, just very quickly, it's not a behavioral finance chapter here. Positive returns are kind of expected because over the long term, investors do expect positive returns. What isn't expected is negative returns. So therefore, this triggers a greater emotional reaction. So as a result, investors are willing to pay more for downside protection through a long put, because that's what a long put is it sets a floor, because it says you have the right to sell at this pre-specified price, versus upside potential, which is what you get from a long call. So again, this is so important as the basis for volatility skew. I'll just say it one more time. Because negative volatility generates a greater reaction, investors are willing to pay more for downside protection. In other words, they will pay more for a long put versus an equivalent long call. So for example, if the spot price is currently trading at $70 and we have a call that's at a strike of 80 and a put at strike of 60, first of all, they would both be out of the money by $10. And just very quickly, let's make sure we understand why that is. Call option says you have the right to pay $80 to buy a $70 asset. I'm not going to do that. This is out of the money. How much is it out of the money? By $10, right? What does a put say? It says you have the right to sell the $70 asset for $60. I'm not going to do that. This put is out of the money. How much is it out of the money? It's off by $10. So they're both out of the money by the exact same amount, $10. However, based on what we just discussed, investors will pay a little more for the out of the money put, even though they are both off by $10 from the current spot price. So the OTM, the out of the money put, will price in a higher implied volatility relative to the out of the money call option. We have to remember the call and the put here is written on the same underlying asset. So the only thing that can differentiate the value of the call and the put is the implied volatility that's being priced in. What I'm trying to do is make a connection between the price of the option and the volatility that's being priced in. So by saying that investors are willing to pay a little more for the put, we're effectively saying investors are pricing in a little more volatility for the put. And this results in the skew in the implied volatility curve. And now I'm going to show you where that comes about. Remember I told you how important it is to understand how this framework functions? So here we are. So we're going to be explaining the volatility skew. And in our illustration, we were comparing an out-of-the-money put with an out-of-the-money call option. And what was our conclusion? We said investors would be willing to pay a little more for the out-of-the-money put option. Done. So there it is. So here's the out-of-the-money put option, and look at the implied volatility there. And now compare that with the out-of-the-money call option and the implied volatility that's there. And there you have it. There you have it. This is just a visual depiction of what we discussed. So because the investors are willing to pay a little more for the out-of-the-money put, they're effectively pricing in a higher implied volatility relative to what investors are willing to pay for an out-of-the-money call option, which would be right here. Now, the sharper the skew, in other words, the higher the implied volatility that's being priced into the out-of-the-money put, the more bearish or the more risk-averse the market sentiment must be. And that makes sense, right? So if we work backwards, so if you're bearish, are you willing to pay more or less for downside protection? We'd be willing to pay more for downside protection, which means we're willing to pay more for an out-of-the-money put, which means we're pricing in a higher volatility for that out-of-the-money put. And as a result, let me just take you to the graph again. So this is our original volatility skew, but as the market becomes more sentiment, look at the chain reaction. We said we are willing to pay more for out-of-the-money puts right there, which means now, before where the implied volatility priced in was here, now the implied volatility priced in would be higher, and therefore the resulting skew would be steeper. So you could see that this new curve is steeper than the original curve. Some notes or observations. First, if we think that the implied volatility on the put is way too high relative to the implied volatility on the call, then the put would be overvalued. Remember the connection between option valuation and implied volatility? So if the implied volatility on the put is high, that means the put itself would be overvalued. And as a result, relatively speaking, the call would be undervalued. But ladies and gentlemen, once you reach this point, in other words, you determine what's overvalued and undervalued, the rest is just automatic. I mean, if something is overvalued, it doesn't matter if it's an option, a stock, a bond, or real estate. If you hear that something is overvalued, you take a short position. On the other hand, if something is undervalued, you take a long position in it. So the logic here is that the call and the put are in the same underlying asset. So there can only be one implied volatility because it's the same underlying asset. And that's why I refer to these as phenomenon, right? Because you have the same asset. It should be the same implied volatility. So why is it that these options, which are written on that same asset, are pricing in different volatility? Back to our original framework. All these options, see these options right here? All of these options are written on the same underlying asset. So whose volatility are we looking at? The volatility of the underlying asset. So why is it that I have different degrees of volatility priced in for the same underlying asset? So therefore, if the investor expects over time the implied volatilities in all these options to converge, again, why would they converge? Because we're looking at the same underlying asset. So you should have the same volatility. Then what would happen is the implied volatility priced into the call should increase, because remember, initially the implied volatility in the call was lower, whereas the implied volatility in the put was higher. So if there's going to be any convergence, the implied volatility in the call would go up and the implied volatility in the put would go down. And let me just take you to the graph again one more time. Now here's what I'm referring to. So because it's the same underlying asset, the implied volatility should be the same for all of them. So if this is the theoretic, right? Theoretically, it should be the same implied volatility, it's the same asset. And here's what it's saying. It's saying that for the out of the money put, the implied volatility should be coming down, Whereas for the out of the money call option, right here, the volatility or the implied volatility should be going up. And that's what I mean by convergence. Now, at the same time, if you're expecting the implied volatility priced in the call to go up, that means the value of the call option itself is going to go up, and therefore we want to take a long position, right? Because then that would appreciate. So remember, when you're long something, it's like an asset. So if the value of your asset is increasing, that's going to result in a gain. At the same time, remember we said we're going to take a short position in the put. Well, as the implied volatility on the put option comes down, the value of the put will come down, and therefore the value of this short position, because remember you're short the put, it's going to come down. And I always like to refer to short position as a liability, because you have you owe because you sold it. So short value coming down, it's a lot like saying the value of your liability is coming down, which also contributes to your gain. And again, this only works if you expect the implied volatility on the options to converge. So then what's the risk? The risk is the following. Remember we said we're going to short the put and long the call. Here's what happened inadvertently. So that long call and short put combination will result in a long exposure to the underlying asset, right? And just very quickly, let me show you why that is, just using visualization. So when you long a call, here's the profile for a long call. When you short a put, here's the profile for a short put. Yeah, but ladies and gentlemen, that's the same thing as having a long exposure to the underlying asset. So now you're exposed to the directional movement in the price of the asset. But the trader is only trying to exploit the difference in implied volatility and not make a bet on the direction of the movement in the price of the underlying asset. So therefore, what the trader has to do is he has to hedge against price risk. How? We offset the long exposure by shorting the underlying asset. So let me just show you again what's happening. So when the investor took a long position in the call and a short position in the put, what was he trying to get at? He was trying to exploit the difference in the implied volatility priced into the call and priced into the put. Yeah, but as he was trying to do that, he created a different exposure, because now he is exposed to what's happening to the value of the underlying asset. So you can see that right here. If the value of the underlying asset increases, he's making money. On the other hand, if the value of the underlying asset decreases, he's going to be losing money. But he wasn't looking at getting exposed to the direction of the price movement. So what is he going to do? He's going to take a short position in the underlying asset. So that's what a short position looks like. And then when you do that, you're going to have these positions offsetting each other. So you can see that a dollar gain there is offset by a dollar loss there. And same thing here. A dollar gain here is offset by a dollar loss there. And what that tells us is that he is no longer exposed to which way the price of the underlying asset moves, because he's effectively created a long and short exposure to the underlying asset. Now, just to simplify things, let's assume that both the put and the call are at the money, because when they're at the money, their deltas are going to be 0.5 for the call and negative 0.5 for the delta, for the put option, because we have to remember put option has an inverse relationship to the underlying asset. But at the same time, we have to remember that when you're long, you have a positive exposure to something, and when you're short, you have a negative exposure. So the way to read the short put position is the following. The fact that you're short explains this negative, but the fact that it's a put, the put does have a negative delta itself. And of course, long is positive, and the call itself has a positive delta of 0.5. And remember, we said we're going to short the underlying asset so that we're not exposed to the direction of the price movement. Well, the underlying asset has a delta of 1. In other words, the underlying asset has a 1-to-1 sensitivity to itself. But again, because it's short, you got a minus there. Okay, so after we remove all these guardrails, it's really just a simple linear equation. So you just solve for that, and you can see that this equals to 0. So the overall delta is 0, which is the same thing as that graph that I showed you, right? So we said when you have that, you are not exposed, you're no longer exposed to what's happening to the price movement or the direction of the price movement for the underlying asset. And there it is. So the overall position is no longer exposed to the direction of the price movement. And instead, the investor is only exposed to change in volatility. And ladies and gentlemen, this is really how most investment strategies work. You create a position and then you hedge away the risks that you don't want. In this case, what the investor did is he went long call and short put because he was after the volatility convergence. But then when he created these two positions, he got a whole bunch of other risk exposures with that. So the trick is you hedge away the risks you don't want, and then you're left with the exposures that you do want. In this case, the exposure he does want is changes in implied volatility.